well, we're in a risk-off market. And I'm a guy, among other things, who likes some risky assets. If there's a situation where there's an asset class that I like, junior resource stocks is an example, or emerging and frontier market stocks, where the overwhelming sentiment is negative. What that means is that sectors that I know extremely well are going to go from cheap to extremely cheap. You won't feel necessarily very good about your existing inventory, but to the extent that you add inventory, you're going to feel fantastic about it. Markets where everybody's overconfident and overpaying for everything are markets where there's not much for me to do. You know, if you compete with dumb money, you are dumber money. But the truth is, you're seeing companies that were financed a year ago at $300 million valuations that are now selling at $110 million valuations. And people who would happily pay $300 million for them seem to be unwilling to pay $110 million. From my point of view, this is extremely attractive arithmetic, and it's just going to get better. So if it seems like I have sort of the catbird smile on, it's because I have the catbird smile on. So we're coming into a circumstance where the expertise that I built up over 50 years of investing and speculating is those lessons are going to be lessons that I'm able to employ, which is extremely attractive to me. Volatility unnerves most people because most people only pay attention to the price of their investments. That price information isn't worth anything if you don't have a sense of value. In other words, if a stock is selling for $1, what does that mean? If you think it's worth $2, then the fact that it's selling for $1 is cheap. If you think it's worth 50 cents, then the fact that it's selling for $1 makes it expensive. Most people pay slavish attention to price information and have no opinion whatsoever as to value. So, of course, during periods of volatility, those people that don't have the courage of their convictions, because they don't have convictions, will make mistakes. And those mistakes will inure to the benefit of people who are psychologically and financially prepared. And I'm hoping I'm both. I don't think that the average investor and saver in the United States is as afraid as he or she is going to become. I believe that most people still believe that the big thinkers have their back. I'm not sure that I believe they have my back, but that doesn't matter. I don't make a market. I think in the very near term, we're probably set up for a technical rebound. I think equities are oversold. I think bonds may be oversold because although I think they offer a horrific value proposition, they are regarded by other people as safe havens, irrespective of the arithmetic. So I think in the very near term, we may see a rally. To me, that feels like a sucker rally. Higher interest rates do two very bad things to debt and equity markets. The first is that they raise the issuer's cost of capital. You know, if you're somebody paying the prime rate and the prime rate is 3, your cost of funds is 3. And if the prime rate goes to 4, your cost of funds went up by 33%. Obviously, your margin is the difference between your costs, including the cost of capital, and what you sell your product for. But the other thing that increasing interest rates do is they reduce the value of existing income streams. So if you own a U.S. 10-year Treasury, which you bought a year ago with 125 basis point yield, and today the U.S. 10-year Treasury is selling for a 225 basis point yield, over 10 years, what that means is that your income stream is worth substantially less. Similarly, if competing savings products begin to yield appreciably more than the dividend yield of the S&P 500, as an example, there's going to be disintermediation by income investors from equities and from bond funds into other deposit products. So clearly, if you believe that interest rates are going to continue to rise, in the intermediate term, you believe that long-term bond markets and conventional equity markets are going to continue to suffer. My own particular belief is that at some point in time, it may be a year from now, it may be 2 years from now, that the impact of higher interest rates through the economy is going to be problematic enough that the Fed and the politicians will lose their nerve, which is to say that my bet is that they turn around quantitative tightening and go back to quantitative easing, and they begin to manipulate interest rates down. And when that happens, I suspect that it's really, truly game on for inflation-oriented instruments. If you think about the logical conclusion of what the Fed is trying to do right now, and by the way, I support it, the higher interest rates. But if you think about the logical conclusion of it, one wonders if they might have the courage to let it continue. And so it's likely that over time, there will be selling of that sort of instrument as people get tired of losing 6% compounded. But the impact goes further. Traditionally, by traditionally, I mean over the last 4 decades, most of the time, the U.S. 10-year Treasury has sold for a positive real yield. A positive real yield with the CPI stated rate of inflation is at 8.6 would suggest that the U.S. 10-year Treasury, if it reverted to mean, would have to yield 9. If it yielded 9, you would quadruple the cost of capital charges at federal, state, and local government levels. Imagine the impact on your municipal budget or your state budget or our federal budget. So if inflation is at 8.6 and the Treasury reverted to mean at 9, that would suggest that the first mortgage rate, the 30-year fixed mortgage rate, would have to be at 9.5 or 10. Imagine what would happen to home affordability. Imagine what would happen to people who are in variable rate mortgages. The point of all this is that the political class and the Fed are really truly stuck between a rock and a hard place. They need to let interest rates rise, if for no other reason, so that they have a tool to lower them later when the economy becomes less robust. But they can't let them rise too much, because if they let them rise too much, consumer durable sales, which is to say automobiles, or shelter, which is to say homes, or that whole range of things which are bought on credit, become, from the point of view of most taxpayers and most voters, unaffordable. So we are truly coming into an interesting time, and I'm looking forward to participating in it. But I think focusing on when misses the point, simply because you'll never know when. I think what you have to do is you have to live your life with the sense that there is no necessary answer to the when question. And you have to conduct your life in prudent fashion. Despite the fact that you lose money having cash, you have to have some cash, because cash will give you the tools and the courage to handle volatility. It sounds counterintuitive when you understand that cash is costing you money, but there's an opportunity cost associated with having cash. In a risk-off environment, the price of asset classes which you would normally want to hold for the next 5 years, which is to say precious metals as an example, gold and silver, get soft. And if you don't have the courage of your conviction, it's easy when the gold price falls from 1900 to 1800 saying it's going down and selling it, really truly snatching defeat from the jaws of victory, mistaking volatility for arithmetic, which is a mistake. Similarly, if the S&P 500 is going lower, but if you have specific knowledge around a company and why that company is attractively priced, the fact that a company, that is to say an investment that you know well and feel good about, is becoming less and less expensive is a benefit to you. If you can't think in those terms, the best thing to do is to become extremely conservative, which is to say hold cash, hold precious metals, and have very, very, very low expectations. Or maybe simply pay off your debt and hunker down. That isn't what I'm proposing to do. I'm proposing to take advantage of the situation as opposed to being taken advantage of by the situation.